Hi there, Dan Kurz, DK Analytics. Thank you very much for tuning in. It is Tuesday afternoon on March 31st, 2020. I want to chime in with a video on yield deprivation, corporate anorexia, and moral hazard and how they're all tied at the hip. I've said multiple times I'd discuss corporate anorexia, and I frankly think it fits very well with the current situation we have on our hands that is born of the coronavirus response. Before I do that, let me turn to some valuation metrics. Those valuations or prices are from yesterday's close. The US dollar stood at 99.5. Excuse me, I'm going to explain that one. The Fed's balance sheet all-time high at $5.3 trillion. The US 10-year Treasury yield stood at 0.73%. The S&P 500 closed yesterday at 26.27. Oil at $20.09 per barrel. Gold at $1,635 per troy ounce, and silver at $14.08. After spiking 8% in less than a month on global liquidity concerns, the US dollar is finally reflecting massive debt monetization in the US and is down nearly 4% from its recent March high, March 24th high. Here, a brief confession. I've made one more dollar index change given the Fed's reporting lag, which is worse than it was, and I've switched to the commonly used DXY index. My motto, better late than never. I apologize. This is where it's staying. At 5.3 trillion, the Fed's balance sheet is up 586 billion in 1 week, which would be, if continued, or is an annualized rate of 30.5 trillion. Given the vertical nature of the Fed's current balance sheet expansion, as well as its monetary debasement implications, I've decided to include this metric. The 10-year, the US 10-year, the Treasury, has continued to rise in the back of what looks like a depression in the making, surging late last week on the heels of a record 3.3 million unemployment filing and over 500,000 retail industry workers slated to lose their jobs, with plenty of well-known retail names disappearing forever. For flavor of how aggressive the manufacturing sector is collapsing, in the strongest manufacturing and energy state of the Union, Texas, consider a manufacturing production index's slide from February to March from plus 16 to minus 35. That's a historic reduction. And I'd like to bring it onto the camera here. The source is the Dallas Fed. This is what we're talking about, from 16 to minus 35, which is even steeper than in the 08 crisis in terms of the drop, the size of the drop. All of this weakness in the service and the manufacturing sector makes me wonder again if the coronavirus response, lockdown, or cure is worse than the disease. I say this not to minimize the huge risks associated with this easily spread and potentially deadly virus, which more encompassing data coming in terms of a much wider pool of exposed people showing antibodies is helping to flesh out. Such data, examined, for example, by immunologists at Stanford and Yale, points to a corona mortality rate that is very loosely comparable to other flus. That is, when death rates of generally healthy people are also included. One thing is totally clear, at least to me, however, and that's this. Global and local policy responses are shutting down the world's economy, and a depression looms if we stay this course. Yet, the S&P 500 rose by a stout 11% last week in anticipation of a huge bailout bill, and it rose another 3% on Monday, that is yesterday. By the way, the S&P 500's trailing 12-month gap, generally accepted accounting principles, PE, was 19 yesterday. This is prior to a huge EPS downdraft in Q2 and beyond that will likely compress EPS by well in excess of 50% on an annualized basis. And there will likely not be a V-shaped or a U-shaped recovery, but more of an L with the horizontal line potentially dragging down. In other words, we could stay at very compressed earnings power. Once again, when juxtaposed against 19 multiple of earnings that could easily collapse by 50% or significantly more, I think much more, how does one spell a valuation disconnect? In other words, much too high stock prices, as measured by the S&P 500. Oil, meanwhile, at 18-year lows, remains under stout pressure due to a sharp fall-off in demand, to bloating inventory, and thanks to a market share war that you all know about, led by Russians and the Saudis looking to shut down high-cost U.S. shale producers once and for all. Gold, in the interim, has rallied back 11% from its March 2020 low of $1,492. Silver, meanwhile, is up 15% from its shellacking, and it went all the way down to $12.27 on March 16th. Separately, two different gold and silver dealers have confirmed to me that physical gold prices are 100 to 200 over spot, while physical silver prices for minted coins are up to $10 over spot, and silver round prices are up to $3.50 over spot. Surging premiums, in other words, thanks to which is triggering surging bullion prices, and that in turn is thanks to, you guessed it, scarcity. Buyers often have to wait for months to get their coins or their rounds. As regards the topic at hand, our depressionary trajectory will only serve to worsen the impacts of yield deprivation, corporate anorexia, and moral hazard, all of which, as I state, are tied at the hip. We all know the 11-year plus yield deprivation story called ZIRP and NIRP. QE extended this to the longer end of the curve, with central bankers with electronic money printed out of thin air competing for long bonds with other investors, pushing up the value of bonds, that is, driving down their yields. Yield deprivation has long and serially screwed savers, legitimate savings, pensioners, sound investment, and price discovery, while it has fueled huge misallocations that market-based interest rates would have never financed. It has also long buoyed debtors, spendthrift governments' large deficits, cronyism, and other forms of redistributionism. It has also buoyed the S&P 500 C-suite executives' propensity to buy back overvalued shares with artificially cheap debt. This has incentivized top brass to binge on financial engineering over real engineering or organic growth. Standard & Poor's 500 corporate treasuries have typically been the largest equity buyers of all over the past decade. This has pushed up the price of companies' stocks and driven top brass's outsized sign-on options packages deeply into the money while simultaneously castrating future product portfolio competitiveness and downturn liquidity and solvency. Hence, is it any wonder that the SEC had forbidden share buybacks until 1982? Collectively, this is what I call yield deprivation fueled corporate anorexia, or the LBOing of America. You know what happens to LBO stubs, leveraged buyout stubs. Enriched but highly indebted shareholders focus on servicing debt incurred in a tax advantage manner instead of on sustaining a business's viability or competitiveness, much less achieving organic growth. If your average S&P 500 company apes buyback disaster queens such as GE and Boeing, which is exactly what has happened, how can the U.S. economy grow, remain competitive, remain productive, much less compete successfully in the global goods marketplace? As Standard & Poor's 500 sales in aggregate account for roughly two-thirds of U.S. economic output, this isn't a sideshow or a mere detail. Let me offer you some graphic examples for flavor. Let's see if I get this graph here onto camera. This is called CapEx growth slower than buybacks and dividends. All right, here we go. You can see the very top of this here, that's dividends, and then buybacks, and then debt, and then at the bottom, lagging way behind, is CapEx, or capital spending. And what you can see is that CapEx has been outpaced annually for the S&P 500 by much higher dividend, buyback, and debt growth. The debt is obviously up more because the cash flow couldn't finance both the stock repurchases and dividends, so they had to add debt, right? But what was languishing the whole time is CapEx. That's the point, right? As regards Standard & Poor's 500 CapEx from 2010 to 2017, the period I just showed you, that amounted to 4.6 trillion CapEx did, but it was exceeded by 2.9 trillion in buybacks and 2.3 trillion in dividends, or a total of 5.2 trillion versus CapEx of 4.6 trillion. This is courtesy of Deloitte. If we look at a more recent number from 2012 through 2019, U.S. corporate share buybacks totaled a whopping 4.5 trillion, outstripping CapEx by an even much more pronounced margin as corporate debt soared, which ironically caused the Fed, the yield deprivation father, if you will, of its corporate anorexia and LBO mad progeny. It caused the Fed to fret about dangerously high corporate debt, the very enabling institution through yield deprivation. Talk about an arsonist worrying about a spreading fire. And one last dimension, courtesy of Yardeni and Company, which show buybacks and dividends as a percent of operating earnings. Let me just focus on the bottom part of this chart. Here we go. That's this, right? It's buybacks and dividends as a percent of earnings. It stretches all the way back to 99, and these two things together, buybacks and dividends, in earlier era equals 50 to 75% of operating earnings. And then we got into trouble here with the dot-com boom, which then popped, and we went off the deep end and sowed the seeds for this decline. But we've been revisiting past mistakes, apologize, in terms of now buybacks and dividends equaling or surpassing operating earnings. And this is actually an understatement of the amount of funds committed to both these non organic growth capital spending measures. Most specifically, think about the fact that non-tax deductible buybacks and dividends exceeded or reached not only operating earnings, but they exceeded net earnings, which is after interest and tax payments, by a significantly larger margin because net earnings are substantially lower than operating earnings. This also at least partly explains why serial S&P 500 LBOers had to plug the financing gap with ever more debt assumption. Taking advantage of ZIRP, or zero interest rate policy, to leverage the balance sheet, shrink the equity base, and shrink the share count to leverage net earnings at the EPS line versus investing in the business to drive top line growth is great financial engineering in the near term for the few. But it is the antithesis of sustainably competitive product portfolios, growing the economy, growing the labor force, and increasing exports, in the process increasing America's manufacturing competitiveness. It is also the antithesis of decreasing the nation's 500 billion to 600 billion annual net trade deficit, which has been growing, not shrinking, since '09, another testament to C-suite enrichment and corporate anorexia. Is it any wonder that the SEC wouldn't allow buybacks until 1982? Once again, for your consideration. I'm going to tie this into moral hazard, starting with the U.S. government. The U.S. federal government, with 23.6 trillion in debt, some 106, 107% of GDP, spends about 4.5 trillion per annum, which its unprecedented 2.2 trillion stimulus slash bailout legislation called the 880-page CARES Act will expand. That will expand the 4.5 trillion in spending by a whopping 49%. The federal government's deficit, meanwhile, the U.S. federal government's deficit is set to more than triple into the $3 trillion range as receipts plunge, tax receipts plunge, and depression-like outlays surge. Remember, one only pays taxes on profits. The same government, which, together with state and local governments, has materially locked down the economy, the country, and has effectively incentivized many employees to choose 4 months of government unemployment pay, which typically exceeds their wages or salaries, over returning to work, courtesy of a $250 billion set aside for unemployment checks. That same federal government will also send cash to American families totaling $300 billion. That's 14% of the total bailout amount. Send $100 billion to hospitals. Add $325 billion in bureaucratic funding. Send $340 billion to state and local governments, with more in the pipeline. Mete out $350 billion in small business loans that don't have to be repaid if employees are retained. That, as you can guess, is the favorite part of the bill, if there's anything favorable to it. Extend the U.S. government will extend $500 billion in loans for big corporations and bail out airlines to the tune of $58 billion. Separately, and on top of the 2.2 trillion bailout, the Secretary of the Treasury will transfer $425 billion from the Exchange Stabilization Fund of the Treasury, those are U.S. taxpayer funds, to the Fed so it can effectively lend it out 10 to 1, giving the Fed $4.25 trillion in bailout buying power wherever liquidity or counterparty risks threaten to disrupt our credit-based financial system, or the prevailing artificially low interest rate diktat imposed by the Fed. That 425 billion will, I'm sorry, the resulting 4.25 trillion, 10 times the 425 billion, will also stand ready to purchase treasuries that foreign net creditors holding 10 trillion in US paper either decide or need to sell to finance their own economic implosion issues, meaning there's not going to be so much money from the rest of the world available to the United States. And they might even have to sell US assets. Plus, the Fed has set up special purpose vehicles to get around its charter. That is, beyond its charter-imposed inability to monetize government debt, which it has long violated. Specifically, it has set up a special purpose vehicle, hanky-panky or lawlessness, that allows the Fed, or that has enabled the Fed to engineer a way to buy state bonds, municipal bonds, commercial paper, junk corporate debt, and even equities that lack an explicit government guarantee. In essence, the Fed will nationalize broad swaths of financial markets and de facto industries. And I don't need to revisit the bailout story for Wall Street hedge funds and private equity crybabies for you to sense where this bailout is clearly going, namely to the 1%. In a nutshell, anything to sustain yield starvation or deprivation and misallocations and to drive down surging junk bond yields in both state and corporate realms, from Illinois to Boeing, much like the Fed intervened in the repo market starting last September for similar reasons. Said differently, anything to sustain and expand the Fed's central planning power and its counterfeit currency, including, if necessary, becoming the world's largest hedge fund, should the need arise, a status the Swiss National Bank and the BOJ have long vied for. And I thought central banks were supposed to focus on maintaining a currency's purchasing power. Hell, all central banks want is inflation. They even have inflation targets. They will get more than they want. It's not a question of if, just when. And they are working hard at it. What exactly is the moral hazard here, beyond the fact that the Fed will effectively print the money with which to make kleptocrats whole, despite their debt binges and buybacks and speculations gone sour? And the Fed will make these kleptocrats whole without requiring this entitled class to share a dime with taxpayers if they end up making a lot of money again. How does one say privatizing gains and socializing losses at taxpayers' expense? How does one spell TARP on steroids? Who says white-collar crime doesn't pay or isn't worth repeating? The biggest societal moral hazard associated with this crony bailout is arguably the surge in the CPI tally of inflation, the CPI version of how inflation is measured, that the Fed and other central bank financed bailouts will unleash, especially on the heels of our coronavirus lockdown response, which threatens to shrink services offerings, our global supply chain, and thus our goods making capacity, possibly for a protracted period, resulting in even more dollars and other fiat currencies chasing too few goods and services. Hello, Venezuela? Venezuela has experienced hyperinflation despite a steep economic contraction. They're both possible, and in fact, they tend to occur at the same time. I say this for those thinking that we will remain stuck in deflation despite a promise to print whatever money is necessary. In the US, inflation will surely be amplified by foreign creditors gladly selling their dollars, perhaps sooner rather than later, to a Fed ready to scoop them up with its newly proclaimed limitless asset purchasing power. Those same net creditors, again with 10 trillion in US dollar assets exposure, that have also been extending America a new 600 billion per annum in funds to hang itself with, those foreign creditors will begin to fret, I think, over an America doubling down on record deficits, record money printing, and record amounts of new debt. Meanwhile, it will become harder and harder for foreign creditors to ignore property right protections and rule of law safeguards, both of which are getting increasingly eviscerated by American power brokers. This kind of creditor disdain and treatment, in addition to having long weaponized the dollar, may result in America's cost of capital and inflation rates having banana republic attributes, at least eventually, and perhaps sooner than we think, maybe 70s style, if that suits you better. In other words, creditors and pensioners suffering from yield starvation will get another kick in the pants, while spendthrift states and municipalities and serial stock repurchasing corporations can count on yet another bailout financed by the Fed, by Main Street makers, by future generations, and by inflation. What's the moral hazard message? Those suckers that save for rainy day are effectively bailing out spendthrifts and failed entities. In other words, it will entice everyone to become reckless spendthrifts, knowing they'll be rescued, which will further stunt growth while increasing inflationary risks. Our policy response, at least by and large, is thus far the opposite of ethical behavior, sensible behavior, good planning, letting those that acted recklessly fail, free market capitalism, productivity-based deflation, and the best possible wealth of nations trajectory for the most people. Our policy response refutes all those key attributes that further the best trajectory for the greatest number of people, both in terms of economics and in terms of freedom. Instead, this latest bailout more or less promises, well, it does promise even more money printing, first and foremost, even more debt, that's also clear, even more misallocations thanks to artificially low cost of capital, even higher real-world inflation, too much money, too few goods and services, and last but not least, survival of the least fit and reckless, financed by the fit and prudent. How does one spell ass backwards? This is also known as socialism, where the fascist faction is competing against the communist faction for dominance. At least, if you don't like those terms, let's call it raging statism, which always guarantees the worst result for the most people, be it financial or freedom-based, even as the kleptocrats close to the money printing, be they on Wall Street or K Street or in the bureaucracy, will continue to do very well indeed. Moreover, socialism's finest hour, the world's biggest bailout ever, signed by Trump last week, which is likely just the first iteration, also promises to encourage a run on the dollar. As said, which may well give us unimaginably unaffordable interest rates and plummeting PEs. Said differently, a dramatically higher nominal and real cost of capital juxtaposed against a much more virulent form of stagflation than we saw in the 70s. This will make it even harder to return to sound economics, finances, and policies, much maintain a civil society and avoid anarchy and the answer to anarchy. In such a world, fleeing yield deprivation or bond bubbles, fleeing expensive stocks when dialing in earnings power that will fall off the cliff and likely stay on the floor, and fleeing richly valued real estate whose rental value will likely be under sustained assault given our cure is worse than the disease response to the virus. That remains my belief. Such flight will likely, from such assets and such valuations, will likely be a good allocation or reallocation recipe. In a nutshell, avoid duration or interest rate sensitivity risks, avoid bail-in risks in terms of unnecessary bank accounts or security deposit box assets, and offset central bank financed bailout risks with scarce, vital assets that can't be printed with real assets and or hard assets. And along those lines, allocate funds to real money, physical gold and silver, which could well bestow on you cash on steroids buying power with which to purchase much more assets from stocks to bonds to real estate in the not too distant future. I hope you found my ponderings worthy of your time. This is Dan Kurz of DK Analytics. It is Tuesday afternoon, March 31st, 2020. I'm going to sign off and say bye-bye.